Hello, welcome to another episode of the Capital Employed podcast. Joining me in conversation for this episode was Shree Viswanathan, who is the founder of SVN Capital. In this episode, Shree provides an overview of his investment process and style. Shree has just 11 stocks currently in his portfolio. He walks us through his thesis for investing in 2 of these stocks, both of which are high quality compounders. I really enjoyed listening to him and I think you will too. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okay, let's crack on. Please enjoy my conversation with Shree. Hi Shree, thanks for coming onto the podcast.
Hi John, thanks a lot for having me. It's a pleasure to be on your program and sincerely appreciate you inviting me here.
Yeah, it's a pleasure to have you on. Can you provide an overview of SVN Capital and what is the philosophy and investment style?
SVN Capital is a patient, long-term investment platform that's devoid of the 3 T's that are the bane of investing: transaction cost, taxes, and turnover. And it also has a very equitable fee structure. We can get into that later. But when you spend some time in any particular industry, you sort of observe and learn its strengths and weaknesses. I always knew that when I launched my fund, it would be devoid of certain skeletons. So what are they? I'd like to highlight about 5 of them here. Lack of alignment of interest is number 1. I believe this has a reverberating impact on many other aspects of the fund management business. But there are about 15,000 mutual funds in operation, more than 50% of which have $0 invested from their portfolio managers. I have invested more than 90% of my liquid net worth into SVN Capital. Good alignment of interest. Number 2 is short time horizon. Thanks to high frequency trading and general human tendency to want everything immediately, average holding period of a New York Stock Exchange stock has come down to 5.5 months, from as much as about 7 years in the 1940s. One of the most powerful forces on earth that I try to tap into for generating my returns is compounding. Holding securities for a short span of time not only disrupts such compounding, but also leads to detrimental tax impact. At SVN Capital, I think about holding securities for at least 7+ years. Number 3 is frequency of trading. One of the reasons why fund managers trade very frequently is because of more information. However, in investing, more information leads to less returns. Number 4 is over diversification. Currently an average mutual fund has about 100+ securities in an equity mutual fund. There are both empirical and practical evidence for why such over diversification hurts performance over time. As a one-man investment committee, I find concentrating in 10 to 15 securities decreases risk as I make investment decisions after intensely studying, thinking about the business, and building up a level of confidence. And finally, number 5 is fees. Investment management is one of the few industries where a long-running practice has been that the manager gets paid irrespective of the eventual returns generated for the actual investor. At SVN Capital, I've designed a very equitable fee structure where I get paid only a performance fee, a minimum threshold of 5%, above which is when I get paid. And there is no management fee. A structure where I make money only when I make money for my investors. So that's the investment philosophy and style.
I completely agree with you when it comes to concentration. It's amazing how many stocks some of these funds do hold. What type of businesses do you like to invest in? What are the characteristics you look for?
I describe SVN Capital as a value-oriented fund with a heavy quality overlay. My investment criteria entails answering the following 4 questions affirmatively. Number one, do I understand the business? I'd like to remain within a circle of competence. I have certain preference and experience in certain areas, and try to avoid things like pure commodity businesses like energy, oil and gas companies, Bitcoin, biotech, stuff like that. So I'd like to stay within a circle of competence. That's number one. Number two, and that's a very important question, is it a high quality business? What I mean there is, can the business grow its intrinsic value at high rates over long time horizons? In my estimation, quality is more important over holding periods, as one's long-term returns will approximate the company's internal returns on capital over time. The type of quality businesses that I look for not only generate this high return on capital, but also have good reinvestment opportunities. The combined effect of high incremental return on capital and reinvestment rate, I believe, leads to high growth in intrinsic value. Number three, is the business run by honest and competent management teams with skin in the game? Now, management's primary objective should be to allocate capital so as to generate a return on capital that's in excess of cost of capital. And as a minority, patient, long-term investor, I believe it's only reasonable to expect my share of the capital to be allocated efficiently. What I have found in my experience is that many owner-operated businesses are able to address this important question of capital allocation very efficiently. 8 of my 11 portfolio companies are either owner-operated or family-controlled at this point. So that's number three. Number four, is the business available at a reasonable valuation? I look at this from a variety of different metrics and try to appreciate the quality of the business and the corresponding valuation through that angle. So those are the four questions I want to have answered affirmatively before I can actually invest. And that sort of drives the type of businesses that I invest in.
And what would cause you to sell?
That's the most important problem that many investors face. There is no specific right methodology, but for me to sell, either quality of the business, quality of the management team, one of the two must have been disrupted relative to my original thesis. Number two, if I find better investing opportunity outside the current portfolio. And so those sort of drive my sell decisions. Looking back, most of my issues have been in this area of selling. There is no right answer to that question, but it's a very important question.
You say you got 11 stocks in your portfolio. Can we talk about 2 stocks that you're really bullish on? What was the thesis for investing?
Absolutely. So the first one I would like to highlight is actually a Swedish company that trades in Stockholm Stock Exchange, a company called Evolution Gaming. In fact, let's actually go through those 4 questions that I highlighted earlier. And what does the company do? Now, Evolution is the live vertical supplier to more than 300 online gaming and land-based casinos. What do I mean by live vertical supplier? Many gaming players around the world increasingly, want to engage with a live dealer when making online bets. Evolution provides everything associated with this live dealer requirement to gaming company operators. Think of DraftKings or FanDuel and other online betting companies that have grown recently over the last few years. Evolution provides that B2B, the business to business kind of a solution to these online providers. They provide everything associated with recruiting, training of game presenters, streaming, production, supervision, customer service, everything. They also provide a broad portfolio of games, traditional table games and traditional land-based casino games like roulette, blackjack, baccarat, and they've also come up with their own games like live roulette, dream catcher, and crazy times. Evolution earns a commission of somewhere between 10 to 20% of what's called as gross gaming revenue. That's essentially the online operators' customer losses. And so these guys capture about 10 to 20% depending upon the operator and the type of game. The company has its live streaming casinos in Eastern European countries, Riga, Latvia, Tbilisi, Georgia, and in Malta. And they have 3 other casinos here in the US and in Canada as well. The quality of the business, global gambling market is huge. It's about 307 billion euros, 80% of which is actually land-based. In the other 20%, there are a number of other subcategories. Online casino is only about 16 billion euro size as of the end of the year 2020. While land-based casinos are growing only at about 2%, online is actually growing at 12%. And live casino is growing at about 30%. Evolution is growing at about 50%. Reasons for growth? Scale advantage. Thousands of players can be on a game at any one time as opposed to just a handful in a land-based casino. Market regulation. Many countries are coming out with regulations that sort of attract both players and operators. Internet penetration and bandwidth capacity has improved over time. Also, online payment solutions have improved considerably over time. Those are the reasons for growth of the business itself, and Evolution has been growing even more rapidly only because they're able to offer a variety of high quality games. While that may not sound like much, the technical expertise and the operational execution is of absolute importance to these operators and the players. So competition is another important aspect that I mentioned when it comes to this quality of business. Essentially, Evolution is a monopoly. 60% of the European market these guys have, almost 100% of the US market, which is relatively young, Evolution controls, and increasingly so in Asia. Competitors are UK-based company called Playtech, an Asia-based company that's private, a couple of Asia-based companies that are private. They're still growing, but Evolution CEO keeps talking about how he would like to put distance between itself and its competitors constantly. And they have a good lead at this point. I expect that to continue for a long time. Returns, Evolution benefits from its network effect. As more games are released, more operators sign up and more players sign up, leading to better margins. Since going public in 2015, compounded annual growth rate of revenue has been 50%. Free cash flow has grown from 15 million at that time to 290 plus million in 2020. Free cash flow conversion has been high at a little north of 90%. It's run with no debt on the balance sheet. Return on capital has been 27, 28% consistently. Future growth, I expect that to continue both pre and post-COVID. Behavioral changes, I expect that to stick. As I said, North America is early in its evolution and it's virgin territory for them to capture. How about the quality management team? 2 of the co-founders are on the board. They own about a little north of 10.5%. Another board member owns another 7.5%, 8%. So a good chunk of insiders own stock in the company. Management team is well compensated and well incented. They've been good capital allocators over time, both developing new games as well as in making acquisitions. And so, I like the quality of the management team. And finally, valuation. As I said, Evolution has grown at a breakneck speed over the last 5 years, and I expect that same speed to continue over the next 5. I expect over the next 5 years, free cash flow per share aggregate to add up to a little north of 33 euros. Even at current price, it's had a good move since I bought it, but even at current price, I expect the free cash flow yield to be a little north of 4.5% at a time when 10-year treasury is still 1.6. So those are the sort of aspects that I really liked, and it's the largest weight in the portfolio at this point.
Okay, thanks for sharing that. Yeah, I'm just looking at the metrics. It's ever so impressive. Even the dividend growth as well. It's fantastic.
Yes, thank you.
So how about your second company?
Sure. So this is a US-based company, again, very strong in its competitive edge. The name of the company is Copart Inc. CPRT is the ticker. It trades on NASDAQ. It's about 29 billion. It's the largest salvage yard company in the US. It's one of the two players in a duopoly with approximately 50% share of the market. A salvage yard is essentially the location where damaged vehicles go to for eventual decision. The company owns a little north of 240 lots around the world, actually. It's the dominant position player in the US as well as increasingly in UK, Germany, Mexico, and a few other countries. They have more than 240 lots on over 10,000 plus acres, 8,500 of which are actually owned by them. Since 2003, the company has been conducting all its auctions online. I'll come back to the significance of that point in a second. Think of vehicles getting damaged on the road. Depending upon the seriousness of the damage, the insurance company will decide whether to pay the actual policyholder to go get the vehicle repaired or to call it as a totaled vehicle, meaning total loss, and pay off the policyholder to go get a different vehicle. Increasingly, what's happening is a couple of different dynamics have worked in favor of a company like Copart and its competitor. More and more vehicles have newer technology incorporated into them. More vehicles, because of energy efficiency standards, are made with composite material, which means at the point of impact, the actual vehicle sort of crumbles instead of passing through the impact to the driver or the passenger. And on top of it, almost invariably, except for a few different types of models, almost invariably, technology is all loaded in the front of the vehicle. While head-on collisions make it to the evening news on TV or on print press, the most common type of accident is rear-ending. And the rear-ending vehicle, where the technology is in the front of the front portion of the vehicle, under the hood, that's the vehicle that gets damaged more than the rear-ended vehicle. And so all that is leading to a point where insurance companies are increasingly saying at the point of impact, more and more vehicles are being totaled, sent over to these salvage yards. That is the inventory for a company like Copart. What they do is they take the vehicle in, clean it up, and even if the vehicle is damaged, there are various different parts of the vehicle that become more attractive. And in fact, in many countries, these damaged vehicles are still drivable after a minor fix. And so they bring the vehicle in, clean it up, auction off these vehicles. And for being a middleman between the insurance company and the eventual buyer, they essentially capture a small percentage of the fee. Depending upon the type of vehicle and the holding period and all that, it ranges from vehicle to vehicle, from geography to geography. But think of this as a sort of a marketplace where they're able to capture a fee from both ends of the transaction. And it is the dominant player, as I said, in the US and increasingly so around the world. So that's the nature of the business. What's the quality of the business? I mean, high return generating business, just about 20+% return on capital over a long stretch of time, run almost with no debt on the balance sheet. Two very important decisions made early on have continued to play out, and that sort of falls under the bucket of quality of the business as well as quality of the management team. Early on, they decided to actually buy and hold on to these really large salvage yards in different parts of the country. In this day and age where NIMBYism, not in my backyard kind of approach by many citizens of the US and around the world, it's difficult to set up salvage yards in different geographies. but they have the history of owning these lands in various different parts, and that sort of helps them capture damaged vehicles in various different cities. That's number one. And number two, as I said, in 2003, they decided to switch over to 100% online auction instead of having a small brick and mortar office where they just supply coffee and donuts for people to come in and make a bid. It's a very inefficient structure as opposed to this online. They're now able to ship these damaged vehicles to 190 countries from various different parts of the United States. So that sort of efficiency and that sort of decision making has helped them generate this healthy return. Competition is very limited. There is another player by the name of IAA, which is also US based, publicly traded, has about 30+% market share, but these guys dominate the scene. How about the management team? Well, the founder is still the chairman. His son in law is the CEO. Between them, they own close to 13% of this $29 billion market cap company. As I said, the decision making has been fantastic. High return generating is the focus with no debt on the balance sheet. And they've been very opportunistic in terms of buying back their stock at different points. So that's the quality of the management team. And from a valuation standpoint, again, I look at this from a variety of different angles. Free cash flow, operating free cash flow are the two important metrics that I look for. Again, at a time when 10-year treasury is so low, I'm able to pick them up at almost 2.5, 3 times that rate.
It looks a really interesting company as well. Yeah, thanks, Shree, for sharing that company too. Is there a person that you have met or followed, or possibly a book you've read that has made you a better investor, that has helped you along your investing journey?
As you know, John, ego is the bane of most investors. And that comes from sort of leads to overconfidence and making bad decisions, particularly when it comes to this business of investing. While meditation helps quieten the mind, it reinforces the subject I, which sort of meditates on this object. And meditation is a process where I sit and think about or meditate on something. So there is a subject and an object. That subject I sort of reinforces the ego, and that goes back to the point about overconfidence. So meditation is only partially helpful. And this is a very profound teaching from a saint in South India that I've been following for many years, who lived in the late 1800s all the way to the 1950s. His recommendation was for people to do what's called a self-inquiry. Instead of meditating, ask who that I is. By constantly seeking an answer to that question, that I dies down, and so does the ego. Well, obviously, I have not necessarily arrived at it. The practice of doing this on a regular basis has helped me tremendously. His teachings, the practice, has had a profound impact on how I operate as an investor today. So that's the individual and teachings that I would highlight to answer your question, unless you wanted me to go into an investor-related.
No, that was perfect. It's a really good answer. I think the psychology of investing, that's what I think many people do struggle with, and possibly where they have to conquer their emotions and things. And I think it does take a while to do that.
It is a very important aspect of investing, and particularly during periods like February, March of 2020 or 2008, 2009 sort of time frame. The way you think and operate becomes extremely important for the outcome, particularly over a period of time. And that's what I hope to capture by following this methodology.
So where can listeners go to find out more about you?
So I have a website, svncapital.com. I'm also relatively active on Twitter. Not very, but relatively active. And that Twitter handle is at SVN Capital. I'm also on LinkedIn, where people can find me.
Thanks so much for coming on to the podcast, Shay. It's been a pleasure to listen to you.
Thanks a lot for having me again, John. Greatly enjoyed it.